Hey everybody, welcome to this week's edition of the Raising Millionaire podcast. I am your co-host Roger Bryan, and this is...
I am Richard Lorenzen.
Today we're going to be moving on to part 2 of starting our real estate investment fund. But before we jump into that, we are going to talk markets, particularly trades that we are working on. So Richard,
All right.
my Amazon trade.
Let's do a quick recap of the markets. Markets are up about almost 1% on the Dow, the S&P, and the NASDAQ.
And it's all based on Besant coming out and saying that we're close to a trade deal with India.
Yep. And what's interesting is the market's pretty much posted back-to-back gains the past couple of weeks, past couple of days, yesterday and Friday and Thursday as well, despite mostly negative economic data coming out, including this morning with consumer confidence coming out low. I believe fifth straight month of a low print on consumer confidence. So interesting.
And the worst trade imbalance ever recorded.
Yes. So a lot of interesting activity in the market. Seemingly lots of interesting buying taking place. Anyway, let's go to your Amazon trade.
So when Amazon popped back up recently, first off, I'm an Amazon seller, right? I own an e-commerce business, and I am getting absolutely hammered by suppliers raising prices but not allowing us to raise MAP, which is like a maximum allowed price. So, right, I buy a product. I used to buy it for $104. It sells on Amazon for $199. I typically collect from Amazon $154 net after fees. I've got $50 in between to pay for my shipping, my advertising, my warehousing, all of those other things, right? Amazon has increased prices all over the place, so that number has shrunk. Then the price went up 12%, but we weren't allowed to change the sale price. So what was originally like a 22% margin, it dropped down to 7% and is now at -3%, right? And I'm not the only Amazon seller here. 70% of the products that are sold on Amazon come from China, right? That's not like that's a number that's published. And Amazon is spiking on, well, relative, it was down today, but it is starting to spike on the India news. So not good for me. So coming into earnings, right, we see all of these headwinds. We know that the administration is pushing back hard against China. All of the data states negative economic outlook, right? The market is now back to and above the value it was when Trump announced the tariffs. So it's as if the tariffs don't matter. None of that's been settled, right? But the market's back above that point now.
We are.
That is 2 + 2 = 5. So I saw that as an opportunity to put puts in on Amazon ahead of earnings in 2 days. Now, normally I wouldn't buy an option more than 24 hours away from when I want to exercise it, right? If I'm going to buy into earnings, I would typically do it the day before. This one I bought out a little bit longer, but I also did a little bit of a risk-reward spread. So what does that mean? I bought well into the money instead of at the money, right? So I bought at 195 puts when Amazon was at 185. So that meant that I needed to cover less to get my profit. So instead of my normal 2.3 to 2.9% margin, I was at a 1.45, which means the risk, but also the reward is lower. So like right now, even with Amazon popping a little bit on the India news, I'm still, a minute ago I was up 1%, let me check. Well, now I'm up 2.9%. Doesn't always exactly line up or make sense, but I'm still positive on it so that I gave myself that cushion. If I would have bought closer to the money, I'd probably be at a pretty significant loss already. I'm still waiting for Amazon earnings. I'm expecting worse, well, at expectation or worse, but most importantly, I expect them to draw down on their future guidance, which is what a lot of companies have been doing. And with everything else being equal and China playing a factor, I thought that would be good for a 3 to 5% drop. Remember, I needed 1.45% for profit. Easily lock in a 50 to 100%. This morning, when Trump threw his temper tantrum about Jeff Bezos, you can see them like angrily yelling at each other about what they're doing. I was up 24%. I was like, this isn't what I was trading, so I just let it roll. We'll see if that turns out to be a good idea. So, Richard, that's kind of my explanation on this trade.
Got it.
And I told you the biggest risks I had was any announcement of a trade deal. I was looking at it from a China perspective, knowing that that's not coming, but here's a slight one from India, and then the whole market pops a little bit on it.
Right, and so that was going to be my question for you: is it seems like more or less the catalyst for you getting into this trade hasn't changed. So has your outlook for it changed? Obviously, we saw the dip this morning when there was feuding between Trump and Bezos, and then that dip was recovered by the possible hint of maybe an India deal. But overall, if you look at the 5-day chart on Amazon, it's still trading within a range, like 185 to 190. Nothing seems to have meaningfully changed. So does that change your calculus in terms of whether or not you stay in this trade?
No, I was looking at a retracement from 2 weeks ago when I did this, where we dropped down to like the 170 level, then got back up above 190 with no really sound reasoning why. And then it dropped all the way back down and came all the way back up again. So the expectation is on the back of earnings, unless there's going to be some huge surprise in there with either AI, cloud computing, or ad revenue or things like that, that I should still get that downward leg. And if I got the full downward leg, like a full retracement, man, this would be a 4 to 6x. But if I just get a slight, I'm still at 50 to 100%, which is what I've been hitting on most of my options lately. So fundamentally, everything is still the same. I do have to be careful to make sure that the market doesn't get away from me on the India news. I don't think that that's going to be the case. Like if I had a 1,200 point move in the Dow, I'd probably take a 20-30% loss and move on. But we're 48 hours out. It's always the hard part is the waiting, right?
And Amazon reports at the close on Thursday?
Yep.
Is that right? Okay, until it's Tuesday.
And this expires on Friday, so
okay.
I've also got time value in this that I have to play against too. The closer it gets to expiration, the tighter that margin squeezes, which is one of the reasons I bought out so far.
Got it. All right. So then
we'll see on this one. The last, we hit 2 of them in a row. Then I had 2 perfectly lined up that I didn't pull the trigger on. And then I'm sitting here on Amazon and I missed it the last leg, even though I was calling the exact same movement. So this time I'm going to take it.
The last one being Tesla, right?
Yes.
That's the
I
last
told
one.
you going into earnings that they were going to say that he was leaving Doge or pulling back from Doge and the stock was going to spike. I don't even want to look how much it spiked since then.
It did indeed happen. And I don't remember what the price action was on Tesla.
We were in the 250s and now we're at the 280s.
Yeah.
I think I was looking at 235 on that.
Significant run up in Tesla stock.
Oh yeah, we got to go one
on that news.
Yeah, I was at 235. If you can look at that chart, I was about right there when I said to buy a call option on it. Sorry, fingerprints. Okay, so we shall see how this plays out. I'll check it a couple times during the call just because it's fun to be stressed out over these things. 3.4%.
I figured that's why you were buying deeper in the money, out of the money further out, is you just like getting more stress for your buck.
That's exactly what it does. It's actually supposed to be protection against that, but it just means you have to wait longer, right? If you buy them the day before, you've got 24 hours of stress.
Mm-hmm.
And nearly every time I end up exiting before earnings actually happens because I get some type of move. And if I get it, I take it, right? I'm not trying to be super greedy. Although there have been times where you're texting me and they're like, have you sold yet? I'm like, no, I'm only at 86%. I want 100.
This is true. This is true.
All right.
So
let's talk funds. We are on part 2 of building a real estate fund. Richard, I've talked to a couple people, and there's 3 things. Number 1, we have to build our target list of who we're going to go after, why, and then how we're going to soft intro this.
Yep.
Number 2, we've got to put together our deck.
Agreed.
Yep. And then number 3, I had a great conversation with a buddy that runs an 8-figure real estate flipping business down in Florida. Was that this morning or yesterday? I think it was yesterday. No, it was yesterday. It was yesterday. He is an investor in the venture fund and huge in real estate. And we talked a little bit about how he leverages hard money versus bank finance. And he laughed at me when I asked, how much of your own money do you ever put in on a deal? He just laughed. It's like, not $1. It's always leveraged with OPM, other people's money.
That's a good point, because last week we talked about kind of this like chicken and egg issue of like what happens when we find a great deal, but we don't have the necessary commitments in place to move on it fast enough and it gets bought out from under us. Whereas at the same time, it's difficult to raise money, especially for a new fund, if you don't already have a specific asset, ideally under contract, that you can present to investors as what they're actually investing into, as opposed to just a thesis, right? And so something we could think about would be hard money potentially bridging some of that gap where...
I have the solution to this, Richard.
Okay.
Now, it doesn't make it any easier, but then I ran by him the idea of staging this. Like, right, we want to do 15 million. It's kind of like the macro stage 1, but we break that into 3 parts. The first raise, this is going to be the hardest one, but once you pull this off, everything else becomes so much easier, is 1.5 million, which should get you like 5 to 8 properties. And
that's 1.5 million in investor capital.
Cash.
Okay.
Yeah, cash.
Okay.
Cash in the door. You're going to use that as 100% payment on properties.
Okay.
Right? No leverage whatsoever. It's going to be the anchor of the entire fund. That's going to be the easiest money to bring in because it's going to be dollar for dollar backed with an asset, right?
Yep.
It lowers the risk horizon for everybody involved. And it becomes the anchor, so that next round, you're going to do another 1.5 million, but this time it's going to be 50% cash, 50% financed.
Okay.
Hard money does not work in the buy and hold space unless you have an underlying basket that you can use hard money to bring in the next assets and then go raise money out against it, right? Kind of what you were just saying. So like in the second round, if we had needed to go out and get hard money to close a deal, but then could take that to the investors and say, hey, we've already closed it. We took a hard money loan to get it through the door. Now we're looking for the investors to put into the underlying. And that gives us another 5 to 8 doors. 5 to 8 buildings, because we're trying to do duplexes.
Right.
Then after that, the additional 12 million can be done in stages. Typically, now you're at the 20-80. 20% cash, 80% finance, which any bank will go for these days on business loans, rental properties. Typically means you're at a 10-year to 20-year. You can't get a 30 on that. They don't really even do a lot of 15s in that. They want 10, but with interest rates higher, they've gone out to 20 so that people can float correctly. But then you have this nice pool that you can wrap up, and when it's all said and done, you've got roughly 30% of the overall portfolio in cash, and the other 70%, what it does is it allows for initial cash flow to keep the whole thing afloat through maintenance, administration, and things like that. And then over time, as each property becomes cash flow positive from being paid off, because you're going to have the first set right away, the second set's going to happen in maybe 5 to 7 years, and the third set in 10 to 20. It's going to make more cash available for payouts to the individual investors. So they can start getting those monthly residual checks or monthly payments into like a trust that they can then invest into other assets. I like this model. I don't know if it's complicated. I'll be honest with you. I have not been a big real estate fund investor. I've always just bought for myself. So I don't know. What are your thoughts on this?
It's not complicated. I think what still would be complicated is, um, let's say we decide that this is the plan, right? And we go out and we start raising money. I think the first hurdle you're going to run into for those initial early investors is going to be, what deal are you guys buying?
Oh yeah, that 1.5 is done under commitment letters. And you think about it like this, you probably
Okay.
got to get 2.5 to 3 in commitment letters, so that way the day that you have the deal, it goes out to everyone.
Right.
And you're like, you've got 7 days to fund, and then
Yep.
you start, because everybody's like, yeah, I'll do it, and then you're like, okay, wire me $250,000. Let me see if I can, do this,
Yep.
do that, do
Exactly.
this. It's just that, like I said, that first stage is going to be the hardest. But once you have that underlying those assets on the books, it should get easier.
Yep. Okay. So the next step from there, we need to put together a pro forma that will go with the deck, but a pro forma for what we think the projected P&L of a property might look like, or in this case, it's going to be 8. Did you say 8 properties? For the
Yeah, and
first
that's one of the
5
questions that I have for you. Do you, right? I think of it as almost like you roll up. There's got to be an advantageous reason for someone to come into the earlier stages. But does this turn out to be 3 separate funds, or does it roll up into one macro? When you think about
Well,
it, I want to model it out for all 15 millions came in the door, and here's what it's going to look like.
I think that's the ideal way to do it. The question would be, legally speaking, like for your attorneys, how do they, for the first, let's call it the $1.5 million tranche, how do they write the PPM in a way that it could be in the future rolled into, you get what I'm saying? Because like investors may view that as being like dilutive.
Well, yeah, no, I mean, it's like, it is not dilutive because in the full fund size, the percentage of ownership stays the same, but it's a higher risk horizon. It's a lower risk. I understand what you're saying, and it's one of the things that, like, even when I look at, like, the venture fund, right, we were able to, I think it was, first money came in November of 21, last money came in May of 22, so it was like 6-ish months. Everybody's money was the same, even though deals had been done, right, as you start to build out a fund. And it was the same like when I invested in one of the venture funds that I invested in. They raised $77 million. They did it over like 16 months, but the person that put in the first dollar versus the person that put in the last dollar actually had the same risk horizon because you were buying the whole bucket, the whole portfolio. So that's why, like, when I look at the tranches here, I don't know if there's a one-to-one relationship with the timing of your investment relative to the assets bought in a tranche. Does that make sense?
That makes sense.
I don't know, though, right? Is it going to be less attractive because of that? Or are they going to be able to look at it and, like, do they care if they're dollar? Somebody always cares if they're $1. But if you're $7 versus $25 versus $15 million, is there a difference?
That's a good question.
Most venture funds don't asset allocate in a tranche. It's one bucket.
Right.
But that I've never done a real estate fund, so.
Right. Yeah, but I agree with that. It's one bucket. It's usually one fund, but a PE firm will usually have more than one fund as well. So so maybe this isn't tranches, what I'm thinking of. It's more so, maybe it's fund 1, fund 2, and fund 3.
I just want it to be, I just think it's one fund. And this is the allocation model that we're going to use. Like, you're buying into the whole model, right?
Yeah.
You're not buying into the deals that are done in phase 1 of the model.
Right.
Because it's, when I think of like a venture fund or I think of like seed round investing, now that's totally different.
Yeah,
Right?
I get what you're saying.
Yeah.
If you're buying into a fund, like if you're a venture fund, right? Like if you're investing into a fund that's managed by like Kleiner Perkins, right? You're investing in a fund. It's not like they're bringing an individual startup like Uber to you and saying, well, do you want to participate in this deal?
Why'd you have to do Uber? Why'd you have to do Uber?
I know. I was just as it was coming out of my mouth, I was remembering your unfortunate history with passing on Uber.
You know what the crazy thing is that I later found out? The person that I sat down with in Washington, D.C., I think it had been 2008 or 9, no exaggeration, is actually Krista's cousin who did do the investment. Now, they're not close. He's actually an arrogant you-know-what and lives in Potomac. But it was funny when I had that conversation, I was talking about him, it turns out it was Krista's cousin. That would have been 5 or 6 years before I even met Krista.
Right.
Isn't that crazy?
Wild.
Yep.
Small world.
Ugh. Negative
Where were we?
goosebumps. Okay, back to this fund.
So, but yeah, I get what you're saying. Like, if I were to go invest in a venture fund right now with like a Kleiner Perkins, like I'm buying into a fund, they're not gonna. I don't get any kind of influence over what startups they decide to invest in using that fund. It's basically what you could call like a blank check fund. It's also Kleiner Perkins though, so like they have a brand and a track record and a history. Whereas I know that in the real estate space, but I think this is also probably the case in other asset classes too. For newer funds, a lot of times the fundraise is based on an asset rather than the fund, if that makes sense. Like,
no, it does.
Like, here's the apartment. We have this, 10-unit apartment building. It's under contract. We're raising a fund, the ABC Corp Fund 1, specifically to buy this 10-unit building. This is the pro forma for the returns on this particular asset. Do you want to participate? And the only reason I say that is because it does make it an easier sell to an investor, because as opposed to just them trusting us to go out and find assets that will hit our target return, they can specifically see the asset that we're going to be buying, and they can decide if they want to participate in that particular acquisition.
And we've talked. This is like
this is really more of a marketing question, I think.
It's like the chicken and the egg, though, right? If we put in the first $1 million and go out and buy 4 properties, and the fund is started, and here's the cash flow models, and here's all the infrastructure for it, then everything becomes significantly easier. But then again, we look at, if we go put out $1 million and do this, do we really need investor money, or do we just let that compound every 5 to 7 years and just own the whole darn thing? I want to scale. I want this to be huge. So that's the answer to that question. But you got to getting those first couple deals into the books and everything structured around it is so important.
Yep. Okay.
One of the things too is that we talked about our target audience for this, and we talked about business owners, agency owners. We talked about influencers.
Right.
People that have high monthly cash flow.
First and foremost, we're setting this up as a Reg D, right? And so anybody that we raise money for will need to be accredited. That's number one. And so that means if you're accredited, you have income for the past 2 years of at least $200,000 per year, or you own $1 million in assets, I think excluding your primary residence. That classifies you in the eyes of the SEC as a high net worth individual or an accredited investor. That's who we can raise money from. So within that category, I think the most likely persona there are self-employed people, entrepreneurs, and if we look at our networks, it's probably business owners, agency owners. I could see some certain influencers falling into that category as well.
Yeah. And then so we have that self-employed high net worth individual, has high monthly cash flow, wants real estate in their portfolio, but doesn't want the responsibility of dealing with real estate. The reason that I bring this up is we're not going out and talking to other private equity firms, right? We're talking to a subset of people that might not necessarily need the same thing that a $100 million fund would need and it's not necessarily about due diligence. It's not even about branding or marketing. It's just that like the intrinsic need for them is different.
Yep.
And then
Well,
we talked about wanting to tie in legacy to that, or legacy and trusts. Or I talked about that, not you.
Yep. Yeah. That's basically a second business that you would be building on the back end or front end maybe of this. That kind of feeds a pipeline of potential investors into the fund.
And the value prop for them through all of this is you have underlying asset appreciation. You have
The value prop for investors in the fund?
yeah.
Appreciation, cash flow.
What's the right term? So if you buy a property on a 10-year note with 20% down, 10 years later, it's completely paid off. Is that still part of asset appreciation, or is there a different term for that? Because not only did the asset appreciate in value, but the leverage against it decreased, which actually increased the whole pot, right?
It's loan pay down. It's that's not appreciation in the sense of like a capital gain, but your equity does increase. Like the equity that the fund owns in that property, and therefore the investors as owners of the fund own, increases. But it's not like a capital gains or an appreciation in that sense. It's loan pay down. It's not a taxable event.
Hold on, I'm doing some math here. So we said, so that's 1.5, 0.75, and then 2.4. So that is 3.275, 3.95 million is in cash of the 15 million, right?
Right.
So that means you can leverage that, and that then gets leveraged 5 times. We'll just do times 4 equals 12 million. No, that's 16. And then if each of those have a 11 spread, that means in 10 to 20 years, the fund should have at a minimum of $44 million in underlying assets. That's not counting any appreciation, right? That's just straight
Okay, so that's
math
just
on
pay
pay
down.
down.
Got it. Okay.
And then then you have free cash flow as well.
Right. Yeah. The two value propositions for investors would be cash flow and appreciation, right? And so we can set an average, historical benchmark for appreciation.
Which I have at like 4% right now, which could be a little high. I mean, but some years it's been 10 or 12.
Yeah.
Actually,
That's local to Ohio.
let's see, the average. Wow, it's actually in the United States generally 4 to 5%, but 4.27 since 1967. But
It
then it's up.
fluctuates by region.
Yeah, well, I'm looking at national averages, right? In Massillon, Ohio, it's 5.5%. Nationally, it's 4 to 5%. So we are above the national. We're on the high end of the national average here.
I always viewed Ohio as more of a cash flow market than an appreciation market.
But it's got it all.
Yeah.
So then, I would assume then the day all of the notes are paid off, you sell the whole portfolio to private equity. That way you unlock all of that increase in value for all your investors.
Yeah, that gets into like what's the exit strategy of the fund.
But you have to have one, right? It can't go on forever.
Right. Yeah, there does need to be an exit strategy. It doesn't have to necessarily be that. Like there are some funds that they sell off individual properties, See, this is also where it gets complicated around like how do you structure the fund, because a lot of times you'll have fund one, fund two, fund three, fund four, and so each of those funds has a different time window, and you can sell off the assets in, let's say, fund one. After, let's say a 5-year window or a 10-year window, you sell that off, and the investors recoup their money. So they've earned returns from cash flow, and also returns from the appreciation
We have that inside of our venture fund too, but it's right. You do have assets that can be sold in a timely manner, and that cash sits in the fund. We don't allow individual buyouts. We do allow investors to sell between parties inside of the fund, and we have offered at a substantial discount to buy out investors if they're in a bind, based on that gets messy. I like the idea of a full exit as part, like, I don't know if it's 15 or 20 years. That's a pretty long fund. The numbers have to look really sexy for somebody to lock up money that long. I continue to look at this as something that I'm doing for my kids. Like, this is not part of my personal portfolio. Anything that I put into this is going to be for Carter and Claire. So, like, if it's locked up for 20 years for them, they haven't even graduated college by the time this is done.
Right.
And this is all part of that pro forma conversation, right? We decide on the fund structure, we decide on the asset allocation, we decide on the value prop, we decide on the exit strategy, and this basically builds out the deck for us.
I think we'd also have to get a gauge on the market of LPs that we're raising money from, because I would think that, like, certain exit strategies are going to attract more interest than others.
Oh,
and so
I 100% agree. We can build out the most beautiful modeling in the world, and then we take it to market, and everybody can tell us our baby's ugly and we got to start over. But we have to have something to take to market, though, too.
Well, I think if we look at what else is out there, because I'm trying to pull some stuff up, but I can't find anything just from like a quick Google search. But
well, don't worry, I'll hear the Grant Cardone commercial 17 times on my 5-minute drive home on CNBC today.
I'm thinking about, like, platforms like Fundrise. Like, are you familiar with Fundrise?
Mm-hmm.
They do multifamily too, but I think primarily commercial. And the pitch is something like, I think it's a 5-year window on average. It could be as high as 10, but I feel like it's about 5 for realizing your appreciation. And so, like, if we go to investors, and especially smaller check investors, and tell them that it's a 15-year window to cash out, that's a hard sell.
No, that you're right.
Even with the cash flow, it's a hard sell. Unless, of course, like, there's the flexibility for them to maybe sell their position back to us, or sell it on the secondary.
I feel like you have to have some aspect of that. If you do a Reg D raise and you structure it properly, I wonder what secondary markets can carry.
For Reg D?
Yeah. I mean, unless you issue shares, which is not anything like what I'm talking about. I'm just thinking about my own investments in other...
I think only a Reg D, a Reg A has that functionality, legally speaking.
No, I mean, I've done Reg Ds where I'm getting shares that I can sell on private market, but they're in companies. They're not typically in real estate portfolios.
But you bought it, you were in a Reg D deal, and then you had shares that you could sell in a secondary market in a company.
Oh, yeah, yeah.
I wonder if they...
Equity Zen, things like that.
Yeah. That's true.
You gotta figure almost all crypto raises in the past 5 years, unless you're the Trump family and you don't have to worry about laws, have been done under a Reg D.
I wonder if they convert it somewhere along the line from a Reg D to something else to make this.
Well, it's just in the Reg D. It says you are investing $50,000 and you're getting 50,000 Class A preferred stock, and then that's that marketable asset that can be sold later. And then that asset then can have the dividend, and then the underlying is just the increase in stock price in the private market. That's actually interesting. I've done a lot of work with like Start Engine over the years.
Yeah.
Because then you can have share buybacks at the exit of a property, right?
Yeah. I mean, well, if you exit a property, the investors in that property,
But remember, I'm still thinking one bucket.
right? So the investors in that fund, right? Because everybody in the fund would have had access to that property. They all get some return of capital.
They do, but you can structure it on calls. So you can say, all right, we just sold $1 million in property. We're offering a 70% on face call to stock. And then that stock comes back into the company and it's held. So it increases the value of the shares for everybody else because of that 30% discount. And once that window closed, then the rest of the money is issued as a dividend to the remaining shareholders.
I see. I do agree. We need some kind of an option for people.
Yep. Without that, like, I look at this as like, I want to take it till everything is completely paid off. The underlying, because of the pay down of equity, that it's worth 4 times more. And now that 15 million is worth 44 million, right? That's my rainfall event in that, right?
Yep.
4x, not including appreciation, plus cash flow throughout, right? That becomes a pretty big home run.
Yep.
But I can understand how other investors, like I'm in some funds right now in some projects where people would kill to have an exit strategy from it.
Yep.
Especially we're facing a taxable event in one of them, and it's reeling people to get a 10% of fund value tax bill, and they still can't touch the money for 2 more years, and they're flipping the F out.
Mm-hmm. Okay, so we need to make a note then to build in some kind of mechanism for people to be able to cash out if they want to do so.
Yeah, I've got a vision in my head of how to model the pro forma based on like a $1 per share, 15 million share company. You have so many options once you do something like that. It's just an idea, right? This is call number 2. So between this call and next call, we would prepare the pro forma and start to dive into the data and try to figure out where we might be off.
Yep. Yeah, I think if we can put together a pro forma, and to do that, I guess we also need to start looking at assets that are currently for sale, because I would want to model the pro forma after like a realistic.
I have a lot of the local historical stuff because I watch all of it. The problem is these multi-unit deals, like we were talking about those 4 duplexes, they sell like that, right? So that's a problem.
That's the problem that I had at the top of the call is how do we, if you could find one for sale right now, but if we need to move on it tomorrow, how do we, tactically speaking, what are the next steps?
Yeah, we've got to have, I mean, all the paperwork's got to be in place, all the bank accounts have to be in place, all the corporate entities have to be in place.
Yep. We need to draft a PPM,
pitch deck, pro forma, agreements, everything has to be ready. And then you got to get a little money across the line, because you can go out and you can secure one of those deals on like a 30 or 45 day funding cycle, maybe even extend it even out to 60, and you just got to put $5,000 or $10,000 down, but that money is gone unless you put the right hooks into the inspections. If you don't come up with the rest of the money, and then just play the market, all right? And then go out and like you just go, and you have to make it happen. You have no choice.
Yep.
And it might not be a bad idea to start getting some hard money, soft money, or bank financing lined up as well, so that if you need hard money 20%, but you can finance 80% or bridge, there's a lot that you can do there.
Yep. The money's there. You got to find the right target.
Man, sales suck today. Okay.
All right. Are we winding this down?
We are winding this down. This was a long one.
This was.
Amazon is still trickling along.
It's basically at break even.
Yep.
Markets are still sitting up just shy of 1%. on all the major indexes. So it's a big earnings week. There's a lot going on.
Yep, a lot of the Mag 7 and tech are reporting. Does Facebook report before Amazon? Because I think they do. I almost was on looking at Facebook. Yeah, their earnings are tomorrow.
Okay.
I mean, that might be a bellwether. Like, if Facebook
Yeah.
pops, I might exit Amazon at a little bit of a loss, or right now I'm at a break even. I'm up like 2%. But that will be an indicator of maybe moving sooner rather than later and not even go through earnings. But I don't know. My thesis is still strong, right? I believe in it. The market's just going contrarian to what I think it's like 2 + 2 = 5.
I still think that when Amazon comes out with earnings on Thursday, the guidance is not going to be rosy at all because of tariffs, and so it's a little bit of a different story from Facebook.
They were talking about how, though, that like Amazon's got cloud, AI, subscription services, entertainment, the e-commerce core original business. Facebook has ad revenue.
Yep.
Facebook's kind of a one-trick pony, but that ad revenue is is dictated on retail consumption, which those numbers have not been great. Where's the first place businesses pull back from when things are not looking so rosy? Advertising,
Facebook.
which I never understood as a marketer, but it's just the way that it usually works.
Yep. It should be interesting to see. I am long Amazon, but I've always been long Amazon. I've had it for a long time. I don't even know what price I bought it at, but we'll see where this goes. I'm surprised you don't have Amazon in your 2040 fund.
What's that?
2040 fund. Are you long Amazon?
No, it's never been part of it. The 2040 fund was originally blockchain. So Amazon was not a player in that at the time.
Got it.
But it has transitioned into a lot of AI, and we did really well with Tesla and NVIDIA, right? I think we took Tesla through 5 splits. So even with this most recent stuff, I mean, I think it was less than $100 billion company when we got in. So we shall see how this all plays out. I am Roger Bryan, and that's your co-host,
Richard Lorenzen.
and I am pissed that we will not be at the Berkshire Hathaway weekend meeting this weekend. We talked about it a few months ago and never circled back. We have to go next year. We're pushing our luck not being there this year, if you know what I mean.
Yeah.
All right.
Hold on.
I will talk to you later. Have a good day, everyone. Bye.